Want to get back to the markets now because looks like stocks are holding on to those nice gains we saw this morning. Let's bring in Liz Ann Sonders. She's Chief Investment Strategist at Charles Schwab. Liz Ann, always good to see you. I know you were here in the Google Hangout watching President Biden sign that piece of legislation into law. What are your expectations for what it's going to mean for this economy? And of course, what it's going to mean for inflation?
Well, we certainly can use as a guide the two prior stimulus bills, the main one last year, the CARES Act, and then the supplemental partial bill that kicked in December in terms of what it meant for the boost of the savings rate, how that filtered into consumption, where we saw that consumption biased, and then also a lot of survey data being done with regard to this particular package, and at least from the perspective of consumers, how they anticipate they might parcel that out. And what we've gleaned based on what we've already seen with prior stimulus is that only about a third has actually gone into consumption. It's somewhat evenly divided between boosting savings, paying down debt, and used for consumption. We don't know whether that's exactly going to be the case this time, but I think what the question that is important to think about, we don't know the answer to looking forward, is given that the savings rate is expected to jump from 20% to 27 or 28% once these checks start to be distributed, can we assume that ultimately savings will be brought down to recent trend levels of around 7%? That's where some of the most lofty economic assumptions rest on, is that move well down to normal levels of savings. I just think we might want to consider whether this crisis maybe unleashed a bit of a paradox of thrift and a bias by at least some consumers to maybe sock a little bit more away or use it to pay down debt. So that's the unanswered question at this point.
You know, last year when the market was hitting new highs, even though we were in the throes of the pandemic, we talked a lot about this disconnect between the stock market and what was happening in the economy. Do you think that that's still going on, that disconnect, and to that same degree?
Well, I'm not sure there actually ever was as much of a disconnect as people perceived. Yes, on the surface, if you looked at eras like late August, early September, when the S&P and the NASDAQ broke out to new all-time highs, and the only GDP report we had at that point was the 30% plus drop from the second quarter, it seemed to be an obvious disconnect. But the reality is that, number one, the market almost always moves in anticipation of a coming turn in the economy. So seeing stocks reflect future possible economic growth is not abnormal, but also leadership was so narrow into the fall of last year, just the big five dominating performance, which to some degree was reflective of what was going on in the economy. Then when you got the vaccine news and that prospect of broadening out and reopening, that broadened the market out into more cyclical parts of the economy. And I think, again, that reflected what was going on in the economy. I worry a bit now that we're seeing pockets in the market of extreme speculation, really not supported by fundamentals. It's not pervasive broadly in the market, but there is some risk that maybe the market has priced in a rosier outlook looking forward than ultimately what we're going to get, that maybe the pent-up demand story is overbilled on the good side, given that we've really met that pent-up demand all along. And I think the nature of pent-up demand on the services side is just a little bit different. So I think there is some froth in pockets of the market.
What do you make of the bounce back that we saw in the volatile tech sector recently? I mean, we were in correction. We hit a correction on the NASDAQ just a couple of days ago. Do you think that there's going to be another shoe to drop here and we're going to test those lows again? Or are we sort of in a rebuilding phase of tech right now?
The honest answer is I don't know. What we have seen in the past year, particularly recently, is really extreme shifts on a day-to-day basis, on a week-to-week basis, in where leadership is concentrated and where the laggards are concentrating. And you particularly recently have seen so many of these flip-flop days, these mirror image days, where you have a day where at opposing ends of the performance spectrum, you've got tech and financials, or tech and consumer or communication services, and financials and energy. And then the next day they completely flip-flop and reverse that, who's the leader, who's the laggard. And that has resulted in not quite fully historic extremes, but the spread on a rolling monthly basis between the best performing sector and the worst performing sector, and the volatility around where that leadership resides has been quite extraordinary. And I think that's likely to continue. I think that's the nature of the beast that is the market environment right now, making it somewhat tricky, particularly for individual investors. And I think the idea behind it is not try to figure out in the next month or next 2 weeks or next day what's going to be the winning sector, but maybe consider rebalancing a bit more frequently so that you stay in gear by effectively reacting to these extreme swings and forcing yourself to add where there's short-term weakness, trim where there's short-term strength, and stay in gear that way versus trying to forecast what the next short-term leadership shift is going to be. I think these dramatic rotations are going to persist for a while.
Yeah, and we better get used to it. And it can be dizzying. Liz Ann Sonders, Chief Investment Strategist at Charles Schwab, thanks for being with us.
My pleasure.